Dear investors, hello everyone. The most tragic market movement in the foreign exchange market this week was undoubtedly that of the New Zealand dollar. Looking at the data for this week, the New Zealand dollar, with a weekly strength of -56%, was the only significantly weakening currency among the G10 currencies. On Thursday, there was an extreme plunge of -213, setting the largest weekly decline. Today, we will thoroughly analyze what factors are behind this sharp decline of the New Zealand dollar. Review of the New Zealand dollar's performance this week. First, look at the core data. Weekly strength, -56%, at the bottom among G10 currencies, the only one with a significant decline. Intra-week volatility, weakened continuously from -40 at the beginning of the week, and plunged to -213 on Thursday, showing a one-way downward trend throughout the week. Strength-weakness comparison, it was extremely differentiated from the 107% strength of the US dollar, becoming the weakest currency this week. Technical aspect, the New Zealand dollar continued to decline against the US dollar, hitting a 4-month low, and the bearish trend was fully established. 2. Dissection of the core causes of the New Zealand dollar's plunge. First, the most direct pusher, the strong rebound of the US dollar put pressure on non-US currencies collectively. This week, the US dollar staged a comeback, with a weekly strength of 107% leading the way, directly exerting extreme exchange rate level suppression on the New Zealand dollar. The US dollar index rebounded strongly from its intra-week low. Market expectations for a Fed rate cut cooled significantly, and the attractiveness of the US dollar increased significantly. As a high beta risk sensitivity coefficient risky currency, the New Zealand dollar is extremely sensitive to US dollar fluctuations. The strengthening of the US dollar directly triggered the passive selling of the New Zealand dollar. Funds flowed back from non-US currencies to the US dollar, and the New Zealand dollar, with poor liquidity and the weakest fundamentals, became the preferred for selling. Second, the fundamental cause, the overall deterioration of New Zealand's economic fundamentals and the increased expectation of a recession. This is the core underlying logic of the New Zealand dollar's weakness. Multiple negative data resonated. Point 1. Business confidence plummeted, and enterprises were extremely pessimistic about the economy. The ANZ Bank's March Business Outlook survey showed that the main business confidence index plummeted 26 points to 33. The weighted average score at the end of the month dropped directly to -23, completely falling below the boom-bust line. ANZ's chief economist clearly pointed out that the continuous fermentation of the Middle East conflict led to a sharp decline in economic activity indicators. Profit expectations deteriorated significantly, and enterprises generally believed that this was not a short-term disturbance but long-term downward pressure. Point 2. Multiple investment banks collectively downgraded economic expectations, solidifying the recession risk. ASB Bank, impacted by the soaring oil prices, New Zealand's economy will contract in the second quarter of 2026. The previously expected moderate recovery was postponed to 2027. Westpac Bank downgraded New Zealand's GDP growth rate in 2026 to 1.9%. Expected a 0.9% decline in housing prices and raised the peak unemployment rate to 5.6%. BNZ Bank warned that New Zealand is facing a triple dilemma of weak economy, rising inflation, and delayed labor market recovery. Significantly downgraded the housing price inflation expectation. Point 3. The real estate engine completely stalled, and domestic demand collapsed comprehensively. As the core engine of the New Zealand economy, the real estate market data turned cold this week. The total number of properties for sale rose to 37,638, a new high since March 2015, and a buyer's market was fully established. The national average asking price continued to decline, and housing prices in many regions of the North Island dropped significantly. The traditional peak sales season was completely cooled off. Building permit data showed that the demand for single-family homes continued to be weak. Only the permits for apartments barely supported, and the driving effect of real estate on the economy completely disappeared. Point 4. Consumer confidence collapsed, and domestic demand continued to shrink. In March, New Zealand's consumer confidence index plummeted from 100.1 in February to 91.3, falling below the boom-bust line. Residents' expectations for the future economy, employment, and income deteriorated comprehensively, and their willingness to consume remained low, further dragging down economic growth. The third reason, the key catalyst, the escalation of the Middle East geopolitical conflict and the energy shock hit the New Zealand dollar hard. The continuous deterioration of the Middle East situation became the core catalyst for the accelerated decline of the New Zealand dollar this week. New Zealand is highly dependent on imported oil. The soaring oil prices directly pushed up domestic inflation. At the same time, it squeezed household purchasing power, creating stagflation pressure. The Reserve Bank of New Zealand clearly warned that the New Zealand economy is extremely sensitive to rising energy prices. The energy shock caused by the Middle East conflict will further deteriorate the economic outlook. Market risk, aversion sentiment increased, and funds sold the high-risk New Zealand dollar. They turned to safe haven assets such as the US dollar and gold, further amplifying the decline. The fourth reason, policy level suppression, the expectation of easing by the Reserve Bank of New Zealand increased, and the interest rate differential advantage continued to narrow. The market generally expects that the Reserve Bank of New Zealand will keep the interest rate unchanged at the April 8 interest rate meeting. However, the expectation of further rate cuts continues to rise. Multiple investment banks believe that the Reserve Bank of New Zealand still has room for easing in the future. The market's expectation of a Fed rate cut cooled significantly, and the interest rate differential between the US and New Zealand continued to widen. The attractiveness of the New Zealand dollar's interest rate differential continued to decline, and funds continued to flow out. The governor of the Reserve Bank of New Zealand clearly stated that it will ignore short-term energy-driven inflation. However, if the pressure persists, it will take action. The market interpreted this as a clear easing tendency, further suppressing the New Zealand dollar. Finally, technical and capital aspects, the bearish trend was established, and panic selling intensified. After the New Zealand dollar broke through the key support level against the US dollar, a large number of stop-loss orders were triggered, leading to a panic selling decline. The market's short positions on the New Zealand dollar continued to accumulate, and this week, negative news was released intensively. This triggered further selling after large-scale short covering. The New Zealand dollar has relatively poor liquidity. A small amount of selling can trigger significant fluctuations, amplifying this week's decline. 3. Outlook for the future. The weak pattern of the New Zealand dollar is difficult to change, beware of further declines. Overall, the sharp decline of the New Zealand dollar this week was the result of the resonance of four core factors: the strength of the US dollar, economic recession, geopolitical impact, and policy easing, rather than being driven by a single event. Core conclusion. In the short term, 1 to 2 weeks, the weak pattern of the New Zealand dollar is fully established, and the room for a rebound is extremely limited. It is highly likely to continue to decline to new lows. The target range for the New Zealand dollar against the US dollar is 0.56 to 0.57. In the medium term, 1 to 3 months, the risk of a recession in New Zealand continues, and the expectation of easing by the Reserve Bank of New Zealand increases. The New Zealand dollar will maintain a long-term downward trend unless there are significant positive factors, such as the easing of the Middle East conflict and better-than-expected improvement in economic data. Key risk points: the Reserve Bank of New Zealand's interest rate meeting on April 8, the progress of the Middle East situation, US inflation data, and New Zealand economic data. 4. Summary. The sharp decline of the New Zealand dollar this week was essentially the inevitable result of the overall deterioration of fundamentals and extremely negative external environment. The New Zealand economy has entered the recession warning period, with the real estate, consumption, and corporate confidence all weakening comprehensively. Coupled with the Middle East energy shock and the strength of the US dollar, the decline of the New Zealand dollar is a triple resonance of fundamentals plus capital plus sentiment. For investors, the core contradictions of the New Zealand dollar have not changed: economic recession, policy easing, and the strength of the US dollar. Unless these three core logics reverse, the weakness of the New Zealand dollar will not end. Finally, remind everyone that the foreign exchange market is ever changing, and risks need to be strictly controlled in trading. The above analysis only represents personal views and does not constitute investment advice.